Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And today, Brian and I are going to talk about two big topics. The first one is lower mortgage rates, which, of course, everyone's going to be excited about. Now, hold on. Depending on when you're watching this, you might be like, hold on, the market's high today. The article's about lower mortgage rates in general.
I got something to say about that as well. Just share some information. We'll get to it.
Second topic is existing home sales hit a 7-month high, and existing home sales have not really made their way into our topic index in a very good light recently, but we finally have a little bit of good news, so we're going to talk about that today.
Yeah.
So you want to come out with your point right on top about mortgage rates? What are you going to say?
Of course. So last Wednesday when the Fed spoke, and my whole social media was flooded by, the rates just got cut. Fed just got drop rates, or rates are coming down. And although in theory, yes, that's very true, I have to let you know, you listeners at home, is that just because they signal that the Fed fund dropped the rate, it doesn't signal that mortgage rates completely tanked. It just means that the credit cards, auto loans, and personal loans just got a little bit cheaper. But what that does also mean is that it follows suit. So the trajectory of mortgage rates in time will start coming down as well. So if you heard it from your local realtor or somebody on your social media saying rates dropped, not necessarily mortgage rates, because that same day pricing for mortgage rates got more expensive than that prior day. And that's what it does in the market when the Fed drop rates. That first 2 days, the rate pricing might be a little bit higher, but in the long run, they're going to come down lower. So what does this mean for buyers and homeowners at home? Is that this is the time that you strike, because rates are going to start coming down. So if you get in now, once you're pre-approved or you're in the motion, rates should have already came down as well. And this isn't going to happen overnight. It's going to be a gradual easing into next year that rates start coming down, because we still have another meeting in December. And, based on what we saw, there might be a cut, there might not be a cut, but we are already in the trajectory of going down.
Yeah, so it generally sounds like there's not going to be a rate cut in December, because they're kind of paving the way for, hey, don't get too excited about that. But to your point, look, the market's open every day. So every day, Monday through Friday, the market's open, with the exception of federal holidays and stuff like that. The market's trading, and rates are going up and down as it is live happening real time. Now, most of you have been around here a long time. Like, yeah, duh, you've said that 1,000 times. If you're right here for the first time, look, the market's open every single day. Rates are changing as the market is as well. The reason this is so important is because these two topics go hand in hand today. Back when the Fed was assumed to reduce the rate in September, the week before that, mortgage rates front ran that decision and were lower in the first week of September than they were by the time Jerome Powell and the Fed announced their rate cut. Now, what that happened then in retrospect is people were like, oh wow, the market's finally pivoting back in our direction and affordability can return. The cost of borrowing the money is going to be less. This is going to be more favorable for me now. And you saw a bunch of interest happen. We took way more loan applications in September than we had in August, way more than in July. And so September right now kind of stands as like the tallest mountain on the ridge line of when we received the most applications, and it was completely because of rates.
Yeah.
Now that we had October happen and they did another rate cut, even though that same day rates didn't go down, the general consensus is they're still moving down longer term, and that's going to bode well for going to the end of the year and into 2026.
Yeah, and we've seen it where banks hold the line and they don't drop rates as soon as they hear the whistle sound off. But what it does mean is that they're already tracking what the move is going to be happening in the economy. Therefore, they can start easing rates, knowing that we're going to be getting to a lower level.
Now, I think there's two things happening right now that actually might, I'm going to say, work in the favor of mortgage rates, but it's because of bad situations. Number one is going to be whatever longer term layoffs continue at the corporate level. You saw UPS announce a bunch of layoffs. Yeah. You saw Amazon announce a bunch of layoffs. I'm forgetting a couple others, but you see like thousands or tens of thousands of people being laid off. That's all eventually going to come down the pipeline. Mortgage rates are probably going to be the beneficiary of that, because if there's weakening in the jobs market and unemployment goes up, mortgage rates have to stay down. Now, that's the first thing. The second thing is the government shutdown. I think it's creating uncertainty. Now, hang with me here for this, because there's a thought process. Yes, if people have, let's say millions of people have government jobs, those jobs are getting money every month. And what do we see most recently happen? The banks and the credit unions are like, hey, knock, 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 government, you need to figure this out.
Yeah.
Because now, guess what? Their cash flow is being changed. Now that's in the pipeline of the consumer experience that we have and the consumer culture that we have. So if you're a federal employee and you're not making your $5,000 this month, well, then that $5,000 also isn't going direct deposit into your bank account, which means the bank doesn't have it either, which means you're not spending it, they don't have it, and then you have a second order, third order effects of that happening. So I think, again, thank you for hanging tight here. I think long term, unfortunately, that these things are negative and they're happening, I think you're going to work out better for mortgage rates because you can't sit here and argue that they should be higher given the set of circumstances we're facing.
And you bring up such a good point because whenever government gets shut down, it gets resolved fairly quickly. But we've been at it for a more extended period than we're used to. But we've never came across that problem where you're right. The money that was getting paid to federal workers is now not getting deposited into those bank accounts. But now it's been over almost a month. So that's 2 deposits that should have been in their bank accounts that now at a mass level, those are millions of dollars we're talking about not circulating in the economy anymore.
Yeah, I mean, hundreds of millions or billions.
And some of that still needs to get paid.
Well, and the thing is that, the question then becomes, once it does get refunded, won't there be a little mini windfall? Because, Brian's owed 2 paychecks now. So now he's going to get 2. Yeah, that's fine. But if you set forward a course of trying to guesstimate damage, you're literally just guesstimating the damage and you don't really know. I'm only bringing it up because in the sense of having lower mortgage rates on the horizon for a continuous amount of time, these 2 things, although unfortunate, losing jobs and government shutdown, I think they're actually going to keep mortgage rates suppressed rather than make them shoot through the roof.
Yeah, and an interesting conversation about rates. I had a conversation about somebody wanting an adjustable rate mortgage, and the reason being is because they've been following the market, and they said, hey, well, I could lock it in right now for 5, 3, 7 years, and I could refinance out if I needed to, but at least I know that I could lock my rate in, and down the line, I could refinance out. And I think, it's coming to the point where a lot of people are understanding how to leverage this rate environment, and with a lot more inventory, with a lot more opportunities, you can really make your house affordable if you have the right strategy.
Yeah, and so there's a couple things happening because of this influx of mortgage interest back in September. It's continued into the month of October with the Fed announcing the rate cut. It's probably going to continue through November and even to December, which traditionally November, December, January are colder months literally, and in the finance world also literal.
Yeah.
There's less happening. As we're going to see in a second when we go over to inventory, there's a graph that I'm going to show that shows that. But what's interesting is that inventory is now matching a 5-year high. Mm-hmm. So at the same time, in the same window of time that you see mortgage rates went down in September, they've kind of stayed around that same zone. Interest returned. Existing home sales have gone up. Listings have gone up. There's more inventory now. So inventory is matching a 5-year high, even though it's before COVID. It's kind of like this pre-COVID, post-COVID data world. But post-COVID, we've had inventory now finally matching what we've seen as the highest ever in the last 5 years.
Yeah, and what I take from the article, there's 3 things that stood out for me. First-time home buyers are back, 4% higher than last year. Inventory is up, and longer days on the market. The way I look at that, if you are looking at opportunities or you're looking, how does this benefit me? That means that you have more room for negotiations. That means that there's more price reductions. That means that a house that's sitting on the market, you can now negotiate a better term or better deal for you because of the fact that it needs to get sold and it's been on there longer. And for first-time home buyers to come back, that means that affordability is getting better. That means they're coming out of the woodworks. They're saying, hey, I want to buy a house as much as I'm renting it right now. And yeah, it might be cheaper, but the dream is still to buy my house. And I think it comes with sacrifices that people are now seeing I can make it. Right now is the perfect climate because I know that if I'm buying at this rate, down the line, there's some relief. And I'm hearing it all over the place that if I can get in my house right now, refinance 6 to 8 months down the line, I'll get a little bit of ease.
Yeah, I think for people who are not necessarily concerned about employment, right in front of their face, unemployment right in front of their face, then yeah, absolutely. Anyone who is maybe concerned about unemployment or they've already kind of heard murmurings about unemployment for their specific job or layoffs because of their company situation, it might be a different story.
Yes.
But just the numbers being the numbers, I mean, we finally had an annualized rate of 4.06 million units seasonally adjusted for the year 2025, above 4 million. I mean, back during the COVID days, it was like, oh, we have 2 million with like half of this amount of inventory. But now it's like come roaring back. It's not fully back to where we want it to be. I think the target is like 4.6 or 4.7 million or something like that. So we're at 4.06. Okay, but we've made tremendous progress over the last several years from the gutter and now back to crossing the 4 million total units annualized. That to me is a good sign. Coupled with mortgage rates being lower equals affordability is going to get better. The only thing that could make this like cherry on the top even better is if prices came down, mortgage rates stayed low, and inventory was going high. If those things were all happy, like this, perfect storm.
I got to ask if it's a good time to buy right now. And I told him, honestly, not for everybody. If you're a high income earner, if you're a high saver, and if you have a well enough budget and your debts that you pay a month, right now is probably a good time for you to get in the market. Now, on the flip side, if that isn't you, that doesn't necessarily mean it's not your time to buy. It just means that it's not the time right now. And you do need to do something to be able to then set yourself up to be able to buy. Because if you say, hey, it's not my time, and then you do nothing, nothing's going to change in that year, 2 years, 3 years, 4 years, 5 years, however long it takes. But if you say, hey, it's not my time right now, but this is what I need to do, I need to make a little bit more income, I need to strap down on my spending, maybe I need to shave off a little bit of debt here, and then I'll be ready, then you know exactly what you need to do to be in line to then be ready to buy a property. And I think that's the perfect opportunity for people to take the chance right now to go see where you're at. And if you don't know, and if you're afraid, at least after the consultation, you sit down, you know exactly what you can do and can't do, and then that gives you clarity to run with it.
Yeah, and I really like this last part I want to mention about this one particular article was that first-time homebuyers made up 30% of the September home sales. Now, it was just a couple weeks ago, I was talking about like 55% of quarter 2 sales was investors.
Yeah.
And then the rest of the other 45% was like a blend or whatever. But then, or maybe it was the other way around. Was it 45% that was investors and 55 was the blend of everyone else? Whatever. But the point is, in September, back in this, like mortgage rates come down, inventory surges back, you have 30% of those that had closed were first-time home buyers. Now, let's be honest. Those are also people that had already been in the pipeline in the queue prior to September.
That's what I was going to say.
So this isn't me reading an October number that's based off the September interest. It just happens to be that these closings in September reflect people's anticipation of some things happening in the market and being in line and ready for it when it happened.
I think you said a perfect word. I think it's a perfect time to anticipate. And you're right when you said the people that turned into contracts in September were people that are anticipating. They rode the wave down because they were already in flow of trying to buy a house, and their deal just got better because they were early to the party.
Yeah, they were already ready.
Anticipate.
Yeah, and so that is a word of encouragement for those of you like, well, I don't know if I can buy a house in 2025. Okay, that's fine. Maybe there's only like 7 or 8 weeks. I don't know when you're seeing this, but maybe you're seeing this 7 or 8 weeks left in the year. Maybe only 6 or 5 weeks left until the end of the year. That's fine. You can still anticipate what you're going to move and what you're going to do and what your next move is in 2026 and get started with that process now. It's always the right time to ask, and to your point, it's not always the right time to buy.
No, it's not. And just to add more context, I had someone reach out and say, hey, we're thinking of moving to Texas. What would it look like if I buy over there? This is my budget, this is my income. We did this purchase here a few years ago. And he's like, hey, we just want out. We feel like we have a better opportunity over there. Things would line up a lot better. We have family over there. What does that look like? And I was like, well, that's congratulations. Tell me a little bit more about your plan. And he's like, well, we want to save up a little bit more. We know it's a little expensive here. We have 2 kids. We want to grow the family. So we want to actually be comfortable somewhere where, we can grow our family. So I'm like, great. Let me run some approvals for you. And he's like, and I don't know if I'm going to make this happen or not, but I just want to know what it looks like so that I can make a better decision if it does happen.
Yeah.
So, it starts like that, just asking, what does it look like for me to do this? Don't be afraid.
Yeah, no, it's good. And we're going to go right into the next thing. So it talks exactly what Brian, to your point, though, is like the people asking that question are going to give themselves a better chance at taking a crack at what's available in the market. And we are seeing now that existing home sales increased in September. Mm-hmm. They were up by 1.5%. 1.5% isn't that much. That statistically is probably true.
Yeah.
But compared from where it was, I mean, new construction was like the golden kid on the block forever. New construction this, new construction that, concessions for clothes, like all this crazy stuff that developers are doing to try to get people to homes. It's really nice to honestly sit here and say that existing home sales are back.
Yeah. a lot more inventory, and we've been seeing it. And you know what I get from the article is that all things are pointing to 2026. I know they said maybe things might be flat for the remainder of the year, but we've already seen the positive outlook where, yeah, it might be flat, but next year we can expect it to break out in a positive way for people that are looking to get into real estate. And I think it's very important to note that right now is the time to strike, so that once you're in transaction mode, you know exactly what options are available.
Yeah, I think this is a reflection. Yeah, say that. So a reflection. There's a sweet spot in the market.
Yeah.
Because if the rates have gone down, the cost of borrowing the money's gone up. You have more choices and more options. Even if prices have flattened and stabilized, but the seller psyche. This is really about the seller psyche. It's them saying, I am willing to put my house on the market right now in these conditions, and then immediately become a buyer after that. Now, asterisk, yes, not for the people like death, divorce, that kind of, paying off bad debt, bankruptcy. Yeah. I get that. Scrape all that away. I'm talking about you're a move-up buyer, a lateral buyer, or a move-down buyer. Your psyche of selling right now is in alignment with the people's interest on the buy side, I want to apply for a mortgage and buy a piece of the land side. So these things are converging at a really interesting time. Yeah. I'm gonna say a good time.
Yeah.
Because it's kind of like there's this like. I don't want to say it's like groupthink, like everyone's on the same wavelength, but they're kind of acting like it. Like, hey, you see, right? I see. Okay, you're gonna sell. I'm gonna buy.
Yeah,
let's go.
So and then what that does as well, going into these later years, like holiday season, all this plays a part because there's people that are checked out that completely, even if they would wanted to buy it, they're waiting till next year. That's okay. They already made the decision. They're clocked out for the year. Family time, great. But then there's another wave of people that are literally just prowling for those sellers that need to sell in these ending months to clear out their books or make financial ends meet, but those deals come around in the winter, and as the rates are dropping and this climate is coming out with more inventory, what does that mean for buyers that want to snag up a deal in the winter? There's going to be a lot. It's going to be a holiday season for those that are actively anticipating and are out there looking for homes.
The call they're making in the article is that inventory might even go sideways for the colder months of the year, but that's a great sign compared to going down.
That's when it's cold.
Like if they're going sideways, that's better than declining. And also what that means, and this is like a really early called shot, that just means that the spring might be coming freaking roaring back.
Yeah.
Because all things considered equal from now until, let's say, March of next year, the Fed, maybe they do or don't do another rate cut. All they have to do is keep it where it's at or make it better, as opposed to making it higher.
Yeah.
If they can keep it where it's at and keep it lower, and mortgage rates play around this area they're at now, plus or minus 0.25%, I'm telling you right now, I'm guessing that our inventory and our supply is going to have a roar back in spring.
And even if we don't get a rate cut in December, I still feel that rates are going to gradually still come down because of that cut that they did. Slowly see it in the market, but if then they signal other cut in December, I feel that we're in for a very busy first half of 2026.
I think it's a scale of busyness. Yeah. I think already what we're seeing now, the conditions we have now. Remember, some of these things we see them now, but it takes 3 months or 6 months to actually show up in the numbers and the data. Like we're sitting here talking about stuff right now that was already in the making behind us by a couple of months. So that same thing applied forward in the future. Think about what we're talking about right now, what that might mean for 3 months from now, which is January, and then 6 months from now it's going to be like March, April. That's what we're talking about. Like if you have your eyes set on buying in that time window, these things right now matter, all things being considered equal, move forward.
And I feel that's why, unfortunately, we have the upper hand in this certain case because of the fact that we're seeing this data live every day. We're watching it. We're literally monitoring it. And when it gets to the consumer side, it's already been digested over a month or two. So what you're getting in a way is already a stale market, So it's like by the time you're making a move, things completely drastically change from one week to another. So I think it's very important to know that if you're going to make a move, the sooner that you're able to position yourself to be ready to buy or transact, the better opportunities, the better transactions, the smoother transitions you're going to be able to give yourself. And at the end of the day, I think that's what it is, just having seamless process for your transaction.
And also, I just want to address another thing, like, everyone thinking, I should have done this in 23, or I should have done this in 24. Well, there's a little piece of data that's going to confirm that, which was that the median home price had gone up consecutively for 27 straight months. So for anyone who, for all you who are hating and saying, oh my God, house prices are going to fall off a cliff, in some areas, I saw a report about Austin on the NREP show. They had the graph of Austin had that massive spike in 2024, and then it's like crashing down 20% correct. It was a 20% correction, and it was actually on the same trajectory as their traditional average home price growth.
So they should say we just came back.
So in the small little window of the last 12, 18 months, prices are crashing, but they've actually landed exactly where they would have been if it had charted a proper average course over the last 5 years. So all things being considered, again, if you are feeling like, oh, I should have bought a house 2 years ago, okay, maybe. Well, median home prices is still in your favor, even if you buy now, because again, they don't look like they're going to go down anytime soon. It's selective region by region, has a lot to do with the local economy, has a lot to do with the affordability of the people inside that, the jobs inside that economy, and the inventory in that economy, how many new developers are there, how many existing home sales are coming back. There's a lot of things that could be working in your favor. Don't miss out if you're trying to get into 2026.
And I think it's been, 3-4 years that we've been tracking this exact same data, these exact same months towards the end of the year. And opposed to these previous years, every outlook for that following year didn't have any positivity. And as much as we wanted to look at positive, give some sort of assurance, we knew it wasn't looking pretty. Based on what we're seeing now, it's been positive. It's been reassuring. The numbers aren't lying. The numbers are there to compare and contrast to previous years. And from what we're tracking, 2026 is looking like the year that everybody bounces back, allegedly.
Yeah, it is hard to see it a different way, not because we sell loans, but because it's just all the data that was told to us before that was going to lead to a collapse, lead to crushing our head up against a brick wall, leading to there being projections that were negative across the board. Like, none of that happened. Rates have gotten better since 2023. Inventory has gotten better. Existing home sales are back. Mortgage rates are lower. Like, home prices have stayed the same, flatlined and average, or continued to go up. Median home price is $415,000. 27 consecutive months? Look, you could even take 2 or 3 or 5 or 6 of those last 27 months and go, oh, they had a dip this month. Whatever, up and to the right over any course of 2 years plus is definitely a trend.
Just listening to a lot of the data from, the officials, the higher uppers that, control this data, what it made me realize is that do your own research, do your own digging, try to understand as much as possible, although you may not understand everything. But if you do enough research and you understand at a primary level, you'll be able to know whether they're saying the truth, they're kind of lying, or you're very hope that they say that they're saying they mean what they say. And that's what it's taught me over the years to actually really read the data, but also read the people and read what they're saying and how they're saying it, because their own body language, the way that they deliver words, will tell you a lot of whether they believe it or not. But we've been seeing it so long that we're like, I know he doesn't mean it like that. So you're able to call him out, but you have to just be aware and just pay slight attention, and you'll be able to just be that much smarter when making a decision.
Well, I want to point everyone's attention to the screen for a second, Brian. I'm going to put this graph up where it says U.S. existing home sales. On the bottom, you see existing home inventories and months supply. Right there between the 2023 and 2024 are the winter months.
Yeah.
That's, November, December, going into January and February. So, of course, we're going to see a little bit of a lull in existing supply. Fast forward to the winter of 2024, that same November, January, and then January, February, November, December, January, February. Look, a little bit of a dip, but it's higher than it was in 2023, 24.
Yeah.
And look where we're at right now. Like, right as we start in November of 2025, we are significantly higher than the prior 2 years' lows during the winter season. So if this is the low point of the next swing up, then I think we might see more existing home supply continue to come to the market, because only price pressure, unaffordability, increasing rates, or all out people just getting sick and tired of trying is going to draw that number back down, because sellers are going to need to sell for all the right reasons they always do.
Yeah, and if you notice on the top graph, it looks like it's already pointing up. Well, the bottom one stays flat, but I think they're both pointing up, but just waiting to break out one way or the other.
Yeah, and so on the top there, what you're seeing is the existing home sales number compared to mortgage rates. And so if you see the mortgage rate declining, you see the existing home sales increasing. That's that kind of mutually agreed upon agreement that I was talking about a minute ago, where sellers are looking at buyers are looking at sellers, and they're agreeing that they're going to go to escrow together, which I like. Also, last thing on this is there was an economist quoted here who was saying, I was going to say this because this is the first time I've seen this in years. It says, affordability has improved from its worst levels, but remains close to unfavorable readings.
I read.
But at least At least Stephen Stanley, this is the chief U.S. economist at Santander Bank. Affordability has improved from its worst levels. I'm sure he's not the first person to have said this. He's the first person I've seen say that.
You know, it's funny. It sounds like the guy from Family Guy. Training dogs and cats. It's expensive, but not that expensive. But it's still expensive.
Well,
at least they're saying somewhat closer to the truth.
Like I said, he's probably not the first person to say it, but he's the first person I've seen say it in I don't know how many months or years. So if you've seen someone else say it, put that in the comment box below. I'd love to know who it was.
It's funny. I heard something about transitory earlier in a video. Oh man, I know.
Soft landing.
No, it was transitory.
No, I know. I'm saying the other term,
and
transitory,
like, hey,
soft landing, easing of the labor market.
You see what I mean, though? Pay attention.
How easily we go away from terms that aren't suiting us anymore. Isn't it interesting?
Yeah, no. Thank you, Eddie.
All right, Brian. Well, that was all I had for today. So thank you for being ready to talk. And, of course, everyone who's joining us again for another weekly show, thank you for watching. Thanks for tuning in. If you need help with your mortgage, of course, reach out to Brian. You can talk to Will on the team. Put a comment below. We'll reach out to you and help you out. And if you have not yet checked out our other playlist called Friends of Mortgage Heroes, Will, Brian, and myself, we interview our friends in and around mortgage and real estate with the fascinating things that they do in the business business world. So check that out. Be sure to go like those videos. We have some fascinating interviews this year. A lot of heavy hitters and also just some fascinating people. So if you haven't checked that out, go give yourself a second to go check that out. Remember to like this video, subscribe to the channel, turn on notifications and all that good stuff. And for Will, who's not here today, Brian and I are signing off. We'll see y'all again next week. Bye.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.